Alright, so you've just put money into your first Forex account. You've got the charts open, things are moving, and you see like a dozen different trades you could take. You're thinking to yourself, more pairs, more profit. So you jump in, a little Euro USD, a little Pound Yen, maybe some Aussie Canadian, and you feel like a Wall Street pro. You're managing this massive portfolio. But what if I told you that's like the best way to blow up your account? Today I'm going to be boiling down the core mistakes that make most new traders fail. And I'm not just going to point out what you're doing wrong. I'm going to give you exact, actionable steps so you can fix the problems before it's too late. We're going to get straight to the point so you can understand the critical errors that separate the losers from the profitable few. Let's start with that first one, trading everything that moves. I get it. People tend to think that more trades equal more chances to profit. It seems like a smart way to diversify. In reality, it's just a recipe for disaster. Here's the problem. Every currency pair is its own beast. It has its own behavior, its own rhythm. It reacts differently to different news and at different times of day. So when you're trying to track the news, the charts, and the sentiment for 15 different pairs, you're just creating mental chaos. You can't possibly give each trade the real focus it needs. This isn't trading. You're just playing a high-stakes game of whack-a-mole. And your attention is so spread out, you're probably going to miss some really great signals in the process. The fix here is really simple. Become a specialist. To start with, pick one pair, just one. Something like Euro USD, Pound USD, something with lots of volume. Your job is to learn its personality. How does it react in the London session? How does it react in the New York session? What does it do during Asia? How does it react to big interest rate news from the Fed? When you can focus on one thing, you get a really intuitive feel for it. Eventually, you'll start figuring out its patterns. Once you're consistently profitable with that first pair, maybe consider adding a second. Do the same process. Get to know it all over again. Quality over quantity. The next mistake is similar to the first one. This one is just as dangerous and a lot of traders don't see it. It's the mistake of trading pairs that are highly correlated. Let's say you've taken my advice and you've gotten to know Euro USD really well. You're like, okay, I'm ready to pick up a second pair. I find a great setup on Euro USD, and then you see a really similar setup on the pound dollar, and you also enter that trade. You have two different trades open, and you think you're safe and you're diversified. You're not. The thing is, you're kind of just taking the same trade twice. Since both of these pairs are priced against the US dollar, they tend to move in the same ways. There are going to be exceptions, especially if you're scalping really small time frames, you might see exceptions to this rule, but generally these pairs are going to move in the same directions. This is called a positive correlation. If the dollar suddenly gets strong at the same time, both of these trades are going to go into the red. You haven't actually spread your risk at all. You've kind of just doubled it unintentionally. The solution here is just awareness. As a broad rule, any pair that includes the US dollar is pretty highly correlated. But there are a bunch of tools online to help you see which pairs are really correlated and which are less correlated. So if you really want to trade two pairs, just find ones that aren't correlated very highly. This way, if you do decide to get into two trades at one time, you're splitting your risk instead of doubling it unintentionally. The next mistake is abusing leverage. Brokers love to attract new traders with insane leverage. 500 to 1, 1,000 to 1. It sounds really amazing. With $500, you can control a position worth over 100 grand. And while it sounds like a shortcut to getting rich, it's really just the express lane to blowing your account. Leverage amplifies everything. It amplifies your profits, but it also amplifies your losses. At 100 to 1 leverage, the market only has to move 1% to wipe you out. At 500 to 1, it's 0.2%. The market can move that much really quickly, especially during a big news event. This is one of the biggest reasons that traders fail. It turns a small, manageable risk into a catastrophe. The fix is to change how you think about leverage. It's not a tool for taking massive bets. It's a great tool for capital efficiency. As a beginner, you should be using very conservative leverage. 10 to 1, 20 to 1, that's all you need. The focus should never be on the maximum position size you can possibly open. You need to focus on your risk. The golden rule of risk management still applies. 1% of your account is the absolute max you should be risking on any one trade. If you follow that rule, you're not going to be abusing leverage anyway. Okay, quick pause. If you're finding this helpful, and do me a quick favor and hit the like button. It really helps the channel. The next problem a lot of beginning Forex traders have is trading without a plan. If you open your chart and the first thing you think is, what should I trade today? You have a huge problem. You're not trading, you're guessing. Entering the market without a clear, well-written plan is a path to disaster. It's like trying to sail across the ocean with no map and no compass. You'll end up being driven by random impulses, by fear, by greed. It's not going to go well. When you don't have a plan, you have zero consistency. You opened a trade intending to scalp for 5 pips, and you end up holding it for a week, just hoping it'll reverse. The thing is, if you're not consistent, you're never going to figure out what works. If there's no pattern to the way you trade, you can't quantify it, you can't understand what's working and what's not working, and build off of that. Random trading will not work long term. So the solution is to create a detailed trading plan and stick to it with incredible discipline. It doesn't have to be complicated. It just needs to be a set of rules that you define for yourself. It needs to have your exact entry criteria, your exact exit criteria for both wins and losses. It needs to have your risk management, like the 1% rule that we mentioned earlier. So an example might be something like, I will only trade Euro USD during the London session. I will only enter a long after a break and retest of a key resistance level on the 1-hour chart, with confirmation from the RSI. My stop loss is always going to be 5 pips below the most recent low, and my take profit is the next major resistance level. Test that plan on a demo account and get really confident with it. Once it works, and you know it works, treat it like a non-negotiable contract with yourself. The next problem a lot of traders have is negotiating your stop loss. This one is painful because it's entirely self-inflicted. It's the mistake of either not setting a stop loss at all, or possibly worse, setting a stop loss and then moving your stop loss as your trade starts to go into the red. A lot of traders won't set a stop loss because they're afraid of getting wicked out just before the trade goes in their direction. So they'll leave their position totally unprotected. A trade without a stop loss is like writing a blank check to the market. Any kind of sudden news spike could totally wipe out your account. But moving your stop loss is probably even worse. You set that stop loss because you decided that was the absolute maximum you were willing to lose on that trade. When the market goes against you and you move that stop, you're breaking your own rule on nothing but hope. You're telling yourself, my analysis was wrong, but I really hope I end up being right. Hope is not a strategy. This behavior will turn a small, acceptable loss into an account ruiner. The fix is absolute. Set a stop loss, and don't move it. Put that stop loss at a logical place. Do your analysis and decide at what point are you proven wrong? At what point does price have to hit for you to say, my analysis didn't work out this time? Then from there, all you have to do is reverse engineer 1% risk, and you've also found your lot size. That's it. And once you set it, it's sacred. The only way you're gonna move your stop loss is to make it tighter. If your trade moves into profit, you can move your stop loss forward. But your stop loss never goes more into the red. You plan your trade and you trade your plan. Accepting small losses is the business of trading. Profitable traders aren't right all the time. They're just very good at cutting their losses before they get too big. The final mistake brings all of these together. It's emotional trading, letting fear and greed take control of you. You take a loss and all of a sudden you feel this big angry need to jump back in and make your money back. That's revenge trading. Maybe you see a giant green candle that it's going to the moon and you have to jump in. So you panic buy at the very top because you're scared of missing out. That's FOMO. When you trade from a place of fear or greed, you're throwing your plan totally out the window. Your logical brain shuts down and your emotional brain takes the wheel. And this is when you start putting on way too much leverage, moving your stop loss, and chasing price. And it's the ultimate form of self-sabotage. You've turned on yourself and you are paying the price. The solution here takes discipline. You need to understand what is making you emotional. Is it fear? Is it greed? Is it anger? Figure that out. Develop your trading plan and stick to it. Your trading plan is your logical anchor. If you realize you are emotional and you're having trouble controlling it, just walk away. It is much, much better to simply not trade that day, not trade that week, than to trade emotionally and blow your account. And it really helps to keep a trading journal. It helps to keep track of what won, what lost, but also how you felt. If you notice with all of your losing trades, you felt very emotional, very excited, that probably will tell you a lot. The feeling we strive for when we place trades is almost boredom. Trading really shouldn't be flashy or interesting when you're doing it because you've figured out your trading plan and you're just following the plan. So let's recap the mistakes we talked about today. Trading too many pairs, ignoring correlation, abusing leverage, trading without a plan, ignoring your stop loss, trading emotionally. The path to getting good at this isn't finding out some holy grail indicator or figuring out some super amazing strategy. It's about mastering your risk, having insane discipline, and avoiding as many of these dumb, forced errors as possible. This is a marathon, not a sprint. So focus on the process. If you keep trying to learn from your mistakes, you're going to be miles ahead of everyone else trying to do this. If you're serious about learning more, I've got tons more of free videos for you to check out. And now I'd love to hear from you. What was your biggest trading mistake? Drop it in the comments below and let me know. Let's try to learn from each other. Anyway, I'm Andrew, and I'll see you around.